Hey, what's going on, everybody? It's Steve from the Zahnd team. I want to shoot the month of September mid-month report. Today is September 20th, so you'll have all the latest and greatest data for the month of September. And I'm gonna do so. The people that watch this usually the end are the diehards that love to understand what's going on in the real estate market. So I'm actually gonna show you why now is the best time to buy real estate and how much money you could potentially save because of all the changes that's happened. So if you're interested in knowing why now is the right time to buy, stick to with me to the end. And let's go through this market report. But if you're just here for the goods, let me just give you the super high level stuff. So right now, mid-month, I know the data is not final, and this is only a small sample size of sales, but the average sale price has come in at $801,000, which is 4.49% above. So in this video and on this channel where I do talk about the real estate market a lot, I've been talking about a lot about 2017 and how in 2017 we saw a peak happen in April. Government came in, disrupted the market with introductions of interest rate increases, foreign buyers tax rate increases, and a change to the qualification rate on mortgages. So the same disruptor happened here with inflation, Feds increasing the interest rates to fight inflation. And again, just like in 2017, it introduced a disruptor. And in a disruptive, when a disruptor happens, it takes about 4 months for the market to kind of refigure itself out, exit the old normal market, and enter the new normal market. And I made a prediction that, in the same time frame, in about 4 months, that our market will also enter the new normal market. So let's see how that played out. In April, we had our peak. Disruptors came in, inflation was crazy, Fed started raising interest rates, people started freaking out, market shut down for essentially 4 months, and the market fell accordingly with the exit of the old market and entering into the new market. So as you can see here in the month of May, we dropped 11%. In the month of June, we dropped an additional 6%. In July, we dropped 8.71%. And right around this time, I was talking about why now would be a great time to buy because I feel like we're approaching that bottom of the market. And still, hey, I could be wrong and it could go down further, but I just look at the trends and see what's going on here. And we even put out a graphic on our Instagram about how if you qualified for a mortgage at today's average sale price and using today's interest rates versus the average sale price back in March and April, using the rock bottom interest rates, your monthly payment was actually still lower today with the new average sale price. So your monthly payment is actually lower now. And now you actually get the opportunity to enjoy the climb back up to where those prices were back in March and April. And in 2017, it took 34 months from us to go from the peak in 2017 to reach to the bottom, which was an 18% drop, peak to trough. And then it took essentially 34 months to recover to the market to 598,000, which is where the first month where we were actually above the sale price that we had in April. So if this is holding true here, which so far it is holding true, we had our peak, 4 months of correction, and then it should end in August here, and then a recorrection starting for the next year or so, and likely in maybe 34 months or less, or maybe a little more, we should hopefully be rebounding here back to where our average sale price was in April, right? So I mean, now is that's why you want to buy now, not when the market goes crazy again, interest rates drops, people are competing and beating each other up for one house. That's when you don't want to be buying necessarily because you are in so much competition. It's very stressful, and you're not buying at the bottom of the market. You're kind of buying at the top. So right now here, when the market has slipped, especially in our area, which is a very stable market, we have slipped down here, and now would be the right time to buy because it's you save a bunch of money, and I'll show you that a little bit later about why now is the right time to buy. But that's just the general consensus here. So as you can see here, we are following a very similar trend. And just like in September of 2017, the market went up here as well, from 460 to 473, and we're here at 767 to 801. So similar kind of trend, and that's the major news I wanted to share with you there, and as well as the list price to sale price ratio has steadily been dropping from the exact same time. So from April all the way down to August, and now it's U-turned a little bit. Not dramatically, but it's showing a little bit of an indicator of a U-turn here of 94% list price to sale price ratio. And another indicator is that back-to-back months now, we're looking at 28 days on market average. I know this is the mid-month report. We still have to wait for the last sales to come in, but I just really wanted to check on the pulse here and see what's going on. Okay, so let's take a look at what's going on overall. I'll take us from the left to right here. I'll walk you through this, and then we'll kind of look at the planner I built to show you the difference between buying in February, March, April versus buying today. So on the market right now, currently we have 255 units for sale. The 5-year average is 240, and all the asset classes are pretty much right at our 5-year averages right now. So we're back to a normal, stabilized market where the inventory is about the same as it usually is over our 5-year averages. And inventory has been dropping a little bit because we had a steady growth, right? So back in March and April when these changes happened, inventory started shooting up, shot above our 5-year averages, and now for the first time it's dipping down over the last 2 months. It's dipped down 2 months in a row now. So we were at 292 units and now we're down to 255. So we shed about 37 units, so 8% last month and already 5% this month. We're shedding weight here in our inventory. Obviously, compared to last year, inventory is still way up. But last year was one of the most insane years we've ever had, and yeah, we had no inventory. So that is essentially what's on the market, and that just gives you an overview of our supply of the marketplace. And what feeds this inventory number is our supply, inflow coming in and outflow going out. So whatever inflow and outflow is happening is essentially dictating what we have left over in the marketplace. So inflow right now, surprisingly, is holding pretty stable. It's not terribly off of the regular numbers. It looks like it's stabilized. We're at 163 units, which is 8.6 units a day. And that's slightly down from our 5-year average of 9.8 and slightly up from last year, which is 7.3. So it looks like, the amount of inventory coming to the market right now is a normal amount of inventory that we should be getting. As far as outflow, outflow is down dramatically. And that's why I was so shocked when I looked at the average sale price and I saw the turnaround in the list price to sale price ratio. I was actually kind of floored because this is the number I saw first. I saw that we only have sold 94 homes in Guelph so far this year, and that is way down. Only 3.1 homes a day are being sold, and it's 50% 5-year average and versus last year, a 50% drop. So unit sales are through the floor, which means if we had enough outflow to actually reduce the inventory, that means we still have a tremendous amount of failed sales, and that was right in there as well. So our failed sales are through the roof. We're failing to sell about 4.6 homes a day, which is 330% more than last year, and still almost 100% more than our 5-year average. So a lot of homes are still failing to sell, but the good news is here that the trend is starting to come down, except, last month it came down and I was hoping that it would continue following. So it has spiked up again. We'll see what happens for the rest of the month. Maybe the inventory has cleansed itself for the month. But anyways, super interesting to see that we've had this many failed sales, low unit sales, 50% down, and yet our market lead indicator stats of like how stable the market is are stabilizing and U-turning, which is I found really interesting. That might just be me, but yeah, and I found it very fascinating that we're still sitting at 28 days on market on average, so that hasn't changed. This price to sale price ratio has U-turned slightly, and the average sale price has bumped up about 4%. I don't expect it to be this at the end of the month, but just the fact that we're even close to being green is pretty interesting. So that's essentially generally what's happening in the marketplace. And as a quick overview here, let's go into the flow report. I haven't updated this. I update this at the end of them every month, so we won't really touch on this. I just want to give you the high level for the mid-month report. And I could just dive into why now is the right time to buy. And I hope you find this useful. And so I took today's mortgage rates. Frank Mortgages is one of the partners that we have that provide amazing mortgages to our clients. You should check them out. We'll make sure we link something in the YouTube video for you to check that out. But Frank Mortgages is great. They send me a report every month to talk about the marketplace and what the interest rates they currently offer. So right now at Frank Mortgages, you can get a 5-year fixed at 4.59. And there's some interesting strategies here. I know I'm not going to turn this into a strategy session, but if you are interested in having a strategy session, I'm more than happy to have one with you. I'm actually thinking about doing a webinar where I bring some people in and do just a real live demonstration about how we can strategize here, because there's a lower rate for the 3-year fixed, and you could essentially play that in 3 years the interest rates will probably be back down again. So instead of getting a 5-year and waiting for 5 years to have an opportunity to renegotiate your mortgage term, you just wait 3 years and play the averages that likely interest rates will come down in the next 3 years. But if you're skeptical of interest rates coming down, then obviously you want to continue taking the 5-year play. For this scenario, I use the 5-year number here. So what essentially I'm doing here is I'm showing, hey, if you had $100,000 right now, what could you get, and how much can your $100,000 take you with purchasing a house? And to back up a little bit, you know how people say inflation, if you have cash in the bank, your money becomes worth nothing because inflation is eating it. That's technically not true, because in an inflationary periods, usually assets suffer a setback in price. So you look at the stock market, you can see that you have tremendous buying opportunities in the stock market. You look at the real estate market, you see a pullback in the real estate market as well. So technically, even though yes, your cash can buy less goods because inflation is eating those, it actually increases your purchasing power to buy assets. So for example, here you can buy an asset for much less than you were able to do 5 months ago. And because of the inflationary pressures and people, getting out of the markets and selling off stuff, it's actually created a buying opportunity, which allows your dollar to go further. So anyways, you see $100,000 here in both scenarios in a down payment format. So I got 100 grand down. What does it look like to buy a house back in April? Well, back in April, the average sale price was $1 million. So technically speaking, you can even buy this house, because there's a rule here in Ontario and Canada where you must have 20% down if the sale price is over $1 million. So you wouldn't even be actually able to buy a house if you had 100 grand down in April if you were looking at the same kind of average sale price. So we're gonna just bypass that rule for this example, because essentially I could just drop this down to 999,999 and we'll be technically at the same spot. So, but interesting enough, you wouldn't even be able to buy this house with 100 grand down. So let's say you had 100 grand down. That essentially gives you 10% down on that purchase price here, and it gives you 13% at today's average sale price. Funny enough, you have an insurance premium that you have to pay to the CMHC, and this is your first savings opportunity. Your CMHC premium on that $1 million house with 10% down would have been $27,000 in CMHC premium. With the same house today, that is $20,000. So right just there in insurance premiums, you saved $7,000. Okay. There's the interest rate that was back in April, it was 2.85%, and here's today's interest rate at 4.59% with Frank Mortgages. Okay, so I did a 5-year term with a 25-year amortization. If you don't know what that is, essentially amortization is the amount of time you have to pay off the mortgage in its lifetime, and the term is the an amount of time you have to essentially have an agreed locked-in price. So, for example, your term is a chunk of time in your amortization. So you have a 25-year amortization, and you essentially have 5 years of pre-negotiated time at a specific rate to pay down that mortgage. And then when that term expires, you have to enter into a new term, and then your amortization is now 20 years, but now you're open to the new market's interest rates. I could shoot another whole video about that, but that's high level what it is. Okay, rewriting the scenario, you have 100 grand down, already saving 7 grand in CMHC insurance, interest rates are the same, and we're doing a scenario of a 5-year term with a 25-year amortization. All right, here's your second set of savings. Land transfer tax on the home that was $1 million, even if that's the same house today, because it's dropped 23% in value, it would have been $16,500 to buy that house back in April for land transfer tax. Today, your land transfer tax is $11,817, another $4,700 in savings. Your CMHC PST, because there's a provincial sales tax on the CMHC insurance, that's also another $500 difference on the savings in PST. Additionally here, as you can see, your mortgage payment would be less today than it was in April, even though you have a higher interest rate today. Property taxes would stay the same, home insurance would stay the same, utilities would stay the same. So your monthly mortgage obligation is technically $505 less per month than what it would have been if you bought back in April. So let's add it all up. So your one-time savings cost is almost $12,000. That's your CMHC, your PST savings, and your land transfer tax savings. That adds up to about 12,000. And your total monthly payment annualized, so $500 a month times 12, you save $6,000 in that year. But hey, we negotiated a 5-year term, right? And a 5-year term, 500 bucks a month over the 5 years is actually $30,000 of savings you get over the 5 years. So when you add up all the savings together, right now it's about $42,000 less to purchase a home than if we would have purchased that same home back in April. Another interesting note here, you have almost 24% of growth that you could get going back to those April prices that's not even in here. So we're talking hundreds of thousands of dollars of potential growth in your real estate purchase if you purchase today and hold it until you get the gains back. So if you believe in real estate, if you believe in the Canadian real estate market and you believe that this is temporary, that is why it's the best time to buy right now. So I hope you enjoyed this. If you found any value, please feel free to reach out to us. Let me know, as well as drop a comment down below. I'd really appreciate it. Hope you have a great day. Thanks so much.